What we are going to start today is capital structure. Before starting capital structure decision or the chapter of capital structure, let us revise something related to cost of capital. I'm not revising the chapter of cost of capital. Basically, we have learned three types of sources of capital. Which are they? Equity, preference, and debt. So what is in equity? The rate of interest or dividend is not fixed. It is not compulsory to pay the dividend, but still there is a cost of equity. In preference, the rate of dividend is fixed, but if the company is not earning profit, it is not liable to pay the dividend. In debentures, the rate of interest is fixed. Also, it is compulsory for a company to pay the dividend. Try to understand, we are removing the point of preferences from here. Let us compare debt versus equity from the point of view of company. So we are doing from the point of view of company. I want answer from one of the student. If I say cost, we have done it in previous lecture n number of times. Which cost will be higher? Equity cost or debt cost will be higher? Which cost will be higher for the company? Cost is always for the company.
Equity.
Equity cost is always higher. Can Sabina, you explain me why equity cost is higher?
As the risk of investor is higher.
Exactly. The what is cost? Yes, go ahead.
So investor expect more returns.
Exactly. Cost of equity is higher because investors' risk is higher in equity, so they will expect more required rate of return. If they expect more, we have done it in cost of equity, that required rate of return expected by shareholders is nothing but cost of equity. So shareholders will always expect higher than debt because debt is non-riskier for them. So from the point of view of the company, required rate of equity shareholders will always be higher than cost of debt. So cost of equity is higher and cost of debt is lower as compared to equity, right? From the point of view of company, now we are going on other side. From the point of view of company, let me write down first what Shabina said. From the point of view of investor, equity is more risky and debt is less risky. And we can understand it. If we invest in debentures, we are going to get fixed rate of return. Whether company earns profit or not, we are not concerned. We are going to get our interest. And so it is more less risky for us. From the point of view of company, which is more risky, equity or debt? I want some other person to give the answer. Debt is more risky. Vinny, can you tell me why?
Because in debt, they have to compulsory pay interest. They earn profit or not.
Whether they earn profit or not, they'll have to compulsory pay the interest. So risk is higher in debt, and as compared to debt, risk is lower in equity. Risk is lower in equity. This we are doing from the point of view of company. So let me remove from the point of view of investor. From the point of view of company, equity is higher costlier, but the risk in equity is less. From the point of view of company, debt is having lower cost, but the risk in debt is higher. Once again, let me explain why the risk in debt is higher. This is one of the most important point in finance. Higher the debt, higher the risk. Debt is riskier. Whether you earn profit or not, say your interest cost is 100 crore and you are earning only 90 crores. You'll have to bring this 10 crore from somewhere, and if you are unable to bring this, your company will go insolvent. Your company will be closed. It is a big risk. Fixed cost is always a big risk. This is a fixed cost. What is the meaning of fixed cost or unavoidable cost? As you have taken the money from the market, you'll have to compulsorily pay the interest, which is not in the case of equity. So I am stretching it, I am repeating it just because I want you to fix in your mind, higher the debt is higher the risk. Now this is a risk return theory of finance. Try to understand once again. I am redrawing this chart. Equity, as far as the cost is concerned, it is having a higher cost. As far as risk is concerned, we are from the point of view of company. It is having lower risk. As far as debt is concerned, it is having lower cost, and so it is having higher risk. If the cost is higher, profits will be lower. If the cost is lower, profits will be higher. Please understand this. In equity, profitability will be lower. Why profitability will be lower? Because the cost is higher and risk will be lower. In debt, profitability will be higher. Why profitability will be higher? Anywhere where the cost is lower, profits are always higher and the risk is always higher. This is nothing but risk return analysis in finance. Whenever the risk is higher, your expected profit is higher. Whenever your risk is lower, your expected profit is lower. So whether you should go for higher profitability or you should go for higher risk, you should balance it. That is what we are going to learn today. But try to understand this risk return analysis. Before going to risk return analysis, let me ask you a simple question. If you are a CEO of a company or CFO of a company, you are going to borrow 100 crore rupees from the market. From which source you will borrow? Whether you will borrow from equity or whether you will borrow from debt. You can give me answer in chat also, you can give me answer orally also. What do you think? From which source you will borrow? Mixture of both. Alright. Anyone with only equity? No. Anyone with only debt? No. So all of you believe it should be mixture of debt and equity. Is it alright? So we will try to balance it. And this is what is the chapter all about. Let us understand the concept of capital structure. Try to understand, one of the objectives of finance is to determine how much money to borrow. Say we are a company XYZ Limited. What is the question? How much money will be required or how much money we should borrow? And this decision is already taken by our CEO, CFO, that the company is going to borrow 100 crore rupees. This is not a capital structure decision. Please try to understand what is capital structure decision. We have already decided that we are going to borrow 100 crore. Now we are deciding, now we are going to that capital structure. We are trying to decide how much of this 100 crore we will borrow from equity, how much of this 100 crore we will borrow from debt, how much of this 100 crore will borrow from preference shares, how much of this 100 crore we will use from retained earning. Everything we are going to decide. But we are deciding, we are removing preference shares and retained earning for the purpose of understanding the concept. What is capital structure is, if I decide 40% should be equity and 60% should be debt, that is 40 crore should be equity and 60 crore should be debt. This is my capital structure. Taking decision about this percentage is nothing but capital structure decision. So what is capital structure decision? Deciding ratio between debt and equity. Sir, how we will decide that? I'll teach you in this chapter. But first try to understand what is capital structure decision. Capital structure is nothing but ratio between debt and equity. And capital structure decision is deciding that ratio between debt and equity. Your 100 crore is not a decision making part. What is capital structure? See, I'm taking another capital structure decision. I decide that I will borrow 30% from equity and 70% from debt. This is capital structure decision. 10% from equity and 90% from debt. Whatever I decide, the deciding proportion of debt and equity is nothing but capital structure decision. Deciding how much to borrow is not a capital structure decision. Ratio between debt and equity is capital structure decision. We are in the chapter of capital structure and we are going to decide capital structure decisions. We are going to take some capital structure decisions. And this is what is chapter all about. Chapter will teach you how to take a capital structure decision. Sabina gave me the answer when I asked her that if I want to borrow 100 crore rupees, from which source I should borrow. She told me mixture of debt and equity. But how much? Mixture can be 10-90, it can be 20-80, it can be 40-60, it can be 50-50. So we will try to take an exact decision that for XYZ company, a good, optimal, profitable capital structure decision is 40-60, 40% equity, 60% debt. Whatever might be the answer, but we are going to take that capital structure decision. And this first two words, capital structure, should be very clear to you. We are not deciding how much money we are going to totally borrow. We are not deciding how much operating profit we will be earning. We are just going to decide how much should be the debt and how much should be the equity given the total borrowings is there. Let us try to understand capital structure decision. Before that, we are going to learn a profitability statement. Now, those who have done costing, this is one of the profitability statement of marginal costing also. In that you might have already learned, but I am assuming that no one knows anything about this profitability statement and I am redoing it. For any company, the profitability statement starts with sales. What they deduct is variable cost. sales minus variable cost is not your profit, because yet you need to deduct your fixed cost. So the name is given contribution instead of profit or earnings. What word is used? Contribution, because fixed cost is yet to be deducted. Minus fixed cost. I will be getting answer of earnings before interest and taxes. In short, it is also termed as EBIT. In financial world, it is also termed as operating income. Income from operations. See, variable cost and fixed cost. Suppose I am doing business of manufacturing this pen. Then all the costs related to this pen is deducted. All the income related to this pen is considered. I am getting operating income. Which two expenditures are yet to be deducted? Interest, dividend and taxes. So they are earning before interest and taxes, which is also termed as operating income, which is nothing but EBIT. From EBIT, I will first deduct taxes minus taxes. And whatever is the answer is termed as EBT. EBT is earning before tax. See, if some of you know profit before tax, it is one and the same. Earning before tax minus, I will deduct taxes. I will be getting earnings after tax. A simple question. I want the answer from you. Why I have deducted this is interest, not taxes. Earning before interest and taxes, I will first deduct interest and then deduct taxes. Probably I have made mistake in speaking this. I have told you that this is taxes. First I will deduct interest and then I will deduct taxes, and that is my question to you. Why I will first deduct interest and then deduct taxes? Anyone?
Because interest is allowable expense.
Interest is allowable expense for the purpose of taxation. So while you are considering your tax, you should consider it on EBT and not on EBIT. Why? Because interest is allowed under section 36 in your income tax act as far as deduction is concerned, and so it is an allowable deduction. So for the purpose of calculating tax, interest should be first deducted, and so I am first deducting interest, then I'll deduct tax. I'll be getting earning after tax, then I'll deduct preference dividend. Now you should get a logical idea why I am deducting preference dividend afterwards. Preference dividend, we have learned it in cost of capital, is an expenditure which is not allowable as deduction in income tax act. So before tax I am not deducting it, I am deducting it after tax. And the last answer that I will get is earnings available to equity shareholders. See what we have done? From operating income, first we have paid to debenture holders, then we have paid to government, then we have paid to preference shareholders. Whatever is remaining is for equity shareholders. It is earnings available to equity shareholders. It is also termed as net earnings sometimes. Once we get earnings available to equity shareholders, I will see what are my number of shares. and I will get answer of earning per share. I will get answer of earning per share. How I will get answer of earning per share? What is the total earnings available to equity shareholders? Say A. Number of shares is say B. How to find out earning per share is earnings available to equity shareholders, which is nothing but A, divided by number of shares, which is nothing but. I will get answer of earning per share. Once I get answer of EPS or earning per share, try to understand. We are going to a new concept which is termed as a PE ratio. Now it is a very important concept in the world of stock market. Let me explain you what is PE ratio. See, I want to invest in the shares of Reliance. From Google, I got that EPS of Reliance is 150 rupees. Earning per share. We have already understood the concept how a company can find out earning per share. This company was having market price of the share. I opened Google, found out what is it right now market price of Reliance. It was rupees 1500. Try to understand the company which is earning per share 150 rupees, the market price is 1500 rupees. I am comparing market price with earning per share, MPS divided by EPS. It is 1500 divided by 150, which is 10. This is termed as PE ratio, price earning ratio. What is meaning of price earning ratio? Price as compared to earnings. What is my price as compared to earnings? Reliance is normally having a PE ratio of 10. What does it mean? Earning multiplied by 10 is nothing but says market price. So only it is termed as a PE or price earning ratio, which is 10 for Reliance. Say for Tata, EPS is 100 rupees and MPS is 500 rupees. Say Tata Motors. PE ratio is nothing but 500 divided by 100, which is nothing but 5. Normally, a company will be knowing its PE ratio. In our case, say PE ratio is 10. You can get PE ratio of the company. Company will say that we normally go around PE ratio of 10. I can get answer of MPS from this. What is MPS? EPS multiplied by PE ratio. Sir, this is a new formula? No. This is derived from the formula PE ratio is equal to MPS upon EPS. So if you want to find out MPS, EPS will go on the side. PE ratio multiplied by EPS is equal to MPS. So from the profitability statement, I have reached up till the answer of what should be my market price of the share. And if I am taking actual figures, what is my market price of the shares? We started with sales. We ended with market price of shares. As far as capital structure is concerned, try to understand. We are not interested in this all things. We will directly start our question with EBIT. I am rewriting it. For any question, whenever we are taking capital structure decision, we are not concerned what operating income company is earning. What is their variable cost? What is their fixed cost? We are not concerned. We'll directly start with EBIT, reduce interest from it. I will get EBT. I will deduct the tax from it. I will get EAT minus preference dividend. I will be getting earnings available to equity share holders. I'll divide it by number of shares. I'll get EPS. EPS multiplied by PE ratio. I will be getting answer of EPS. These things will be useful for me for taking any capital structure decision. Try to concentrate. We are again going to capital structure decision. What is capital structure decision? Is to decide how much money is to be borrowed from equity, how much money is to be borrowed from debt. If I decide 10% from equity and 90% from debt, this rectangle is nothing but capital structure decision. Ratio between debt and equity is capital structure decision. Whenever we are taking capital structure decision, what should be our objective? Whenever we take any decision, there is an objective, right? You are doing chartered accountancy course because your objective is to earn money. Your objective is to lead a good life. My point is, whenever you are taking capital structure decision, what should be your objective? Let me give you a hint. The objective remains the same for any chapter of finance. Anyone? Yes.
Minimizing the cost of company.
Minimizing the cost of the company. I'm just writing down what are your answers, right? Minimizing cost for company.
And maximize the share price, maximizing the share price.
Okay, maximizing the share price. This is a very narrow thinking of what is finance, right? Just minimizing the cost is never the objective of finance. It is reducing the risk also, increasing the profit also. So it is everything. Second answer is absolutely correct. What should be objective is maximizing shareholders' wealth. And let us reduce it to some numbers. Maximizing shareholders' wealth is nothing but maximizing market price of shares. Maximizing market price of the share. How I will decide how much equity I will borrow and how much debt I will borrow? I will decide in both the scenarios. In 5 scenarios, I will find out what is my expected market price of the share. Wherever it is higher, that is a best capital structure for me. Maximizing market price per share is objective of finance, is objective of capital structure decision. I will take the decision which maximize my market price. Sir, sometimes the PE ratio is not given and we cannot find out market price per share. For the purpose of academics, you can take even this objective, maximizing earning per share. Say a company is a private limited company, not listed in the market. This type of company will not be having MPS. Then what will be their objective is maximizing earning per share. So whenever you are taking capital structure decision, if there are 2 options, you are told that take one of the capital structure decision. It is very easy for you. Just find out market price of the share in both the scenario. Wherever the market price is highest, you will be taking that type of decision. So what is the object? See what we are doing technically. We have first understood what are capital structure decisions. Then we understood that profitability statement where the last answer was MPS. And now we are concluding that capital structure decision, the basic objective, the objective is to maximize market price per share. And we know how to find out MPS, right? How to find out market price per share. Let us understand from an example that how we will be taking capital structure decisions. So let me take two situations over here. A company wants to borrow 10 lakhs rupees. A company want to borrow 10 lakhs rupees. And this is situation 1 and situation number 2. This is for the same company, XYZ Limited. It is not for a separate company, it is for the same company, XYZ Limited. In situation number 1, the company wants to borrow a total capital of 10 lakhs. Situation number 2 also, company wants to borrow total capital of 10 lakhs. Total borrowings will not change. This is not the decision which we are taking. In first situation, company decides that out of, sorry, not 10 lakhs, but 1 lakh. Out of this 1 lakh rupees, 40,000 will be borrowed from equity. So 60,000 will be borrowed from debt. And in second situation, the company is deciding that 20,000 rupees it will borrow from equity. So 80,000 from debt. Situation number 1 once again and situation number 2 both are for the same company. Everything is the same except capital structure. What is capital structure in situation number 1? 40-60. What is capital structure in situation number 2? 20-80. So in situation number 1, you are borrowing 40,000 from equity and 60,000 from debt. And in situation number 2, you are borrowing 20,000 from equity and 80,000 from debt. What you are totally borrowing in situation number 1 and 2? 1 lakh rupees. So it does not change. It should not change. Otherwise, you will not be able to take a good capital structure decision. Let me also write down the tax rate over here. Say 30%. So 30% is the tax rate. ROCE I am not right now dealing with. What is the cost of debt or what is the rate of interest on debt is say 10%. Rate of interest on debt is nothing but 10%. What is my EBIT, operating income, or what is my expected operating income? How much total money I am going to invest? 1 lakh rupees. From 1 lakh rupees, 15,000 rupees is my operating income. Sir, 15,000 will remain same in situation number 1 and situation number 2? Yes. We are not deciding how much company will be earning or how much company has earned. That will be same. We are just deciding what is a good capital structure, 40-60 or 20-80. What is the good capital structure? That is right now our objective to decide. So I have done this Excel sheet in such a manner that I will be getting all the answers readily available. Like what is EBIT is 15,000, interest is 6,000. How 6,000? Debt is 60,000. Cost of debt is 10%. So 60,000 into 10% will be 6,000. Earning before tax is 9,000 minus tax is 2,700. Earning after tax is 6,300. Now earning after tax is always equal to earnings available to equity shareholders if there are no preference shares, and here there are no preference shares. We are ignoring preference shares right now. So this is EAT is nothing but earnings available to equity shareholders. Number of shares. How much equity you are borrowing? 40,000. Let me assume one share is of rupees 100. So how many will be number of shares? 400. 400 will be number of shares. What will be earning per share? 6,300 divided by 400. It is 15.75. What is the PE ratio? I am assuming 10. In situation number 1 also it will be 10. In situation number 2 also it will be 10. It will not change. We are talking about the same company, same point, everything same except a different capital structure. So market price of the share is coming to 157.5 in situation number 1. In situation number 2, what we have decided, equity will be 20,000, debt will be 80,000, tax rate, cost of debt, everything remaining same. EBIT also remains same, which is 15,000 rupees. Interest. How I have found out interest in situation number 2? Debt 80,000 into 10%, which is 8,000. Earning before tax comes to 7,000, minus taxes comes to 2,100, and earning after taxes 4,900. And so you will say that, sir, your earnings was 6,300, here it is 4,900. So situation 1 is better. The answer is no. You need to write down what are number of equity shares. How much you have borrowed from equity? 20,000. What is per share price? 100. So number of equity shares will be 200. I will be getting earning per share, which is 24.5. PE ratio is 10 and market price per share is 245. If I am a financial manager, if my CEO gives 2 options, number 1, whether you should borrow 40,000 equity or 60,000 debt, 40,000 equity and 60,000 debt, or whether I should borrow 20,000 equity and 80,000 debt, which is a better situation for the company, I will tell to my CEO, as in situation number 2, your market price of share expected is 245. You should go for a capital structure which is 20% equity and 80% debt. See, this is one of the basic question of capital structure. One company will take 2 different capital structure. What was first capital structure? 40% equity, 60% debt. What was second capital structure? 20% equity, 80% debt. Sir, that 1 lakh rupees is not a part of decision making of capital structure. How much totally will be borrowed should be same in both the situation. How much is your operating income should be same in both the situation. How much is your cost of debt should normally be same in your both the situation. What is tax rate will be same in both the situation, because we are talking about the same company. This is how we take a capital structure decision. What was our objective? To maximize MPS. If we go for situation number 2, 20 is to 80, equity is to debt, then the market price of the share is expected to be 245 and we'll be going for situation number 2. We have taken one of the simplest capital structure decision. We have taken one of the simplest capital structure decision. Let us go to next point. We are going to ROCE, or return on capital employed. Return on capital employed. It is also termed as R, small r in short form. What is return on capital employed? Try to understand. It just means what is your operating income? We all know operating income, right? EBIT. How much money totally you have invested? See, what is operating income? It has not deducted any financial charges like interest, dividend is not yet deducted. So what is profit from operations of your business? That is operating income. How much money is borrowed? Capital employed, or debt plus equity, or total money borrowed. It also includes reserves and preference share capital. Total money borrowed by the company from equity, reserves, preference shares, debt, term loan, anything. Long-term money borrowed by the company is total money borrowed by the company. Now, if I tell you that this company's EBIT is 10 crore and total capital employed is 100 crore, What is return on capital employed? Is 10%. So how we find out R? It is nothing but EBIT upon capital employed. And see the name. You don't have to mug up this type of formulas. Return is profit. And you will take operating profit. On capital employed. So only R is termed as a return on capital employed. Let us see that chart. See here, I am directly getting the answer. This 15%. How I have got 15%? What is total capital employed? 1 lakh. Total capital is 1 lakh. What is EBIT? 15,000. 15,000 divided by 1 lakh is nothing but 15%. So ROC is 15%. Here also see 15,000 divided by 1 lakh in situation number 2. It is ROC which is 15%. So we have understood concept of even R, which is return on capital employed, or ROCE, or in short termed as R. Let us go to another concept in capital structure, which is trading on equity. It is also termed as leverage effect. Trading on equity or leverage effect. Try to understand. It is important in theory. It is extremely important in practical. If you want to understand the chapter of capital structure, if you just want marks in capital structure, that is a different thing. But if you want to understand the concept of capital structure decision, what is capital structure decision? Deciding debt and equity proportion. How much should be borrowed from debt and how much should be borrowed from equity? You will be able to answer directly rather than taking the situation. But let us first take some of the situations in this case. I'm taking situation number 1, which was similar to which I have taken in previous question. It is situation number 1 for a particular company, say X Limited, where the total capital required is 1 lakh. Now you can see in situation number 1 also it is 1 lakh. Situation number 2 also it is 1 lakh, and situation number 3 also it is 1 lakh. So it does not changes. In situation number 1, equity we are deciding 40,000 and debt we are deciding 60,000. So what is our capital structure decision? 40:60. Taxes are 30%. Cost of debt is 10%. EBIT is 15,000, and you can see I have taken 15,000 in all 3 cases. EBIT being 15,000, which is the best capital structure, and I will be getting the answer. So in all 3 cases, I have taken EBIT as 15,000. Minus interest. Now in this case, interest is automatically calculated. If this is an examination, you will have to do it on your own. It is nothing but debt multiplied by interest rate. 60,000 multiplied by 10,000 is 6,000. Earning before tax is 9,000. Taxes will be automatically calculated, which will be 9,000 into 30%. 2,700. Earning after tax 6,300. Number of shares 400. How 400? Each equity share is of rupees 100. You have borrowed 40,000 from equity shares, so number of shares will be 400. EPS is nothing but earnings available to equity shareholders or earning after tax divided by number of shares. P ratio is given 10. So in all 3 cases, I'll be taking 10. Market price per share is nothing but EPS multiplied by PE ratio, and MPS is 157.5 if I go for situation number 1, which is 40% equity and 60% debt. Let us go to situation number 2. All the things remaining same except this capital structure. Equity is 20% and debt is 80%. Tax is 30%. Cost of debt 10%. EBIT interest minus taxes. Let me write down number of shares. Number of shares are 20,000. So this will be 200. This will be, I will be getting all the values and my expected market price of the share is 245. Let me go to next situation. I want to borrow 1 lakh rupees. From equity, I am deciding that I will borrow 10,000 only. And so 90,000 will be borrowed from debt. So what is my capital structure ratio? It is 10:90. 10% equity, 90% debt. If you watch, I am slowly and gradually increasing the percentage of the debt. Taxes 30%, ROCE. Now ROCE is nothing but R, right? What is R in this case? 15%. And we have done how to find out R. It is nothing but EBIT upon capital employed, which is 15,000 divided by 1 lakh. So ROCE or R is 15%. Interest is 9,000, 90,000 into 10%. Earning before taxes is 6,000 minus taxes. I have done 6,000 into 30%. Earning after taxes is 4,200. How many number of shares will be there in this case? 10,000 divided by 100, which is 100 shares. And so I am getting a expected market price which is 420 rupees. Expected market price of the share which is 420 rupees. Which is best capital structure for this company, say X Limited? The best capital structure is situation number 3. Why situation number 3? Expected market price is 420. Here it is 245 and here it is 157.5. Let me ask one of you, why I have written this? Situation number 1 least risky, situation number 2 average risky, and situation number 3 most risky. Anyone with the answer? Why in situation number 1 I have written less risky as comparatively less risky, and in situation number 3 most risky?
Situation where it's comparatively less risk.
Exactly. You decide risk by proportion of debt. I am not saying here the debt is less. It is comparatively less as compared to situation number 2 and situation number 3. So can I say, as we increase the debt, we increase the risk. And so let me go to trading on equity or leverage effect. As we increase debt proportion in our capital structure, never write down debt. We are not increasing debt. We are increasing debt proportion. See, understand. Here the debt was 60,000. Here the debt is 80,000. But the total capital remains 1 lakh. So we are increasing debt by reducing equity. We are not only increasing debt, we are increasing debt proportion. So total capital remains same, debt proportion increases. As we increase the debt proportion in our capital structure, of course, risk will increase. Why? We are increasing debt proportion, and as Sabina said, if you increase the debt proportion, your company's risk will increase, because debt is equal to risk. That we have done in previous explanation also. As we increase the debt proportion in the capital structure, see, debt is less costlier as compared to equity. That we have learned. Cost of debt is always lower than cost of equity. If you are incurring less cost, your profitability will increase. So as the debt is having less cost, your profitability will increase. Profitability basically means earnings. It basically means EPS. And keeping PE ratio constant, your MPS will also increase. Try to concentrate. As you increase the debt proportion in your capital structure, your MPS increase because your EPS increases. Why your EPS increases? Because debt is less costlier. As you increase the proportion of debt, your cost will be lower and ultimately your profits will be higher. And so your market price of the share will be higher. So capital structure decision comes very simple. Try to concentrate. Let me again write down trading on equity in short. Trading on equity or leverage effect. As you increase debt proportion in capital structure, value of company, I am talking about MPS. What is value of the company? Total number of shares multiplied by MPS. Value of the company will increase. So whenever I ask you what should be your good capital structure, your answer should be increase more and more debt. Debt is less costlier and hence your company will be earning more profits. As you increase the debt proportion in the capital structure, value of company will increase. And so my general answer of capital structure is increase as much debt as possible. Then let me nullify the situation. I am taking the same situation which I have taken in the previous case. Total capital 1 lakh. First case 40,000 equity, so 60,000 debt. Taxes are 30% and cost of debt is 10%. In situation number 2, 20,000 is equity and so 80,000 is debt, and in situation number 3, 10,000 is equity and 90,000 is debt. Everything is remaining same as I have done before, right? There is no change happening. Everything is remaining same. My EBIT is 8,000 rupees. My EBIT is 8,000 rupees. So you can understand, see the programming. EBIT in situation number 1, once I write down 8,000, in situation number 2 and 3 should also be 8,000. We are analyzing the same company, 3 different situations. If our EBIT is 8,000 or is expected to be 8,000, total capital employed is 1 lakh, and in different capital structure, which is the best capital structure that we are going to find out. All of you can understand this R, right? It is 8,000 divided by 1 lakh, which is 8%, which is R. Number of shares in situation number 1 will be 400. Number of shares in situation number 2 will be 200. Number of shares in situation number 3 will be 100. PE ratio, as I have decided, will remain 10 in all 3 cases. So try to understand, same situation, everything remaining same, our concept of trading on equity is becoming incorrect. Why I tell you? As I increase the debt proportion in the capital structure, this blue colored mark, which I have circled with red color, In three different situations, I am increasing the debt proportion in the capital structure. Market price is not increasing. Market price is decreasing. What is market price? Expected market price in situation number 1, 35. What is expected market price in situation number 2? 0. What is expected market price in situation number 3? Minus 70. It cannot be minus 70, means it is 0. The earning per share is minus 7. Not positive. Earning can be negative. MPS cannot be negative. But earnings is minus 7. See the earnings per share. 3.5, 0 and minus 7. So the company is worsening as it increases the debt proportion. And so whatever we have written on this page, trading on equity or leverage effect is becoming incorrect. Increase in debt proportion is not increasing value of the company or is not increasing my MPS. In second situation, if I go to this first page, then it is correct. But if I go to the second page, it is not correct. Our trading on equity concept is not correct. And let me go to third page. In this case also, debt and equity portion I am remaining same. So 40,000, 60,000, 20,000, 80,000 and 10,000 and 90,000. Debt proportion. Taxes, as we have decided, will be 30%. Cost of debt is nothing but 10%. So as you understand, I am taking the same situation in all three cases. Everything is remaining same. Here EBIT is 10,000 rupees. Let me write down number of equity shares 400. Here number of equity shares 200 and here number of equity shares 100. This is remaining same in all three situations, so I am not repeating it. And now try to see the market price of the share. As I am increasing the debt proportion in the capital structure, the MPS is neither increasing nor decreasing. As I am increasing the debt proportion in the capital structure, the MPS is remaining same. And so this concept again is not working. As you increase the debt proportion in the capital structure, the value of your company should increase. But in this case, as I am increasing the debt proportion in the capital structure, it is not affecting my market price of the share. My market price of the share is remaining same. See what I have taken all the situations. This is situation number 1, where our leverage effect or trading on equity is correct. As I increase the debt proportion in the capital structure, my value of the company or MPS is increasing. All right. Try to understand what is R in this case. Let me change the color. What is R in this case? 15%? What is R in this case? 15%. How we have found out 15%? Capital employed, EBIT divided by capital employed. EBIT is 15,000. Capital employed is 1 lakh. So ROCE or R is 15%. R is greater than KD. R is greater than KD. Try to understand. In the case where R is greater than KD, leverage effect will work and you should increase the debt proportion in capital structure. Second situation, R is less than KD. See the situation. What is R in this case? 8%. What is cost of debt? 10%. Cost of debt should be before tax and don't do it after taxation. So what is ROCE? 8%. What is cost of debt? 10%. What does it mean? R is less than KD. Leverage effect is not working. Try to understand. As you increase the debt proportion in the capital structure, your NPS is decreasing. So you should not increase your debt proportion. Leverage effect will work negatively. And so you should decrease the debt proportion in capital structure. Any capital structure which is having a less debt will be good for your company. Let us go to third case first. In third case, this is my R, this is my KD, cost of debt. R is equal to KD. R is equal to KD. What does it mean? Leverage effect is not there, is not having any effect. What does it mean? Whether you increase or decrease the proportion of debt, the market price is going to remain same. So it does not make any difference whether you increase or decrease the proportion of debt. So increase or decrease in debt will have no effect. And this all three things, if R is greater than KD, you should increase your debt proportion. If R is less than KD, you should decrease your debt proportion. And if R is equal to KD, it does not matter whether you increase or decrease your debt proportion. This all three situations I have proved with this Excel sheet, right? All three situations, we have taken all three capital structures and we have proved all those three things. And let me again deeply explain you this. If R, what is R? Understand. R is nothing but what company is earning. What is KD? What company is paying. R, what company is earning. KD, what company is paying. So if you are earning 15% and you are paying to bank or debenture holders 10%, then you should not make any partners. You should not issue more equity. You are having, try to understand the word, favorable leverage. What is favorable leverage? In very simple and straightforward language, when R is greater than KD. If R is greater than KD, a company is having a favorable leverage. If company is having a favorable leverage, company should increase the debt proportion in the capital structure. If company can earn less than what is the interest rate, try to understand. I borrow 100 rupees. Let me write it down even. If I borrow 100 rupees, pay interest of 10 rupees on this 100 rupees, and I am earning rupees 8 from it. Basically, means I should not borrow the money and pay the interest because I am not earning enough to pay this interest. For every 100 rupees, I am paying I am getting 8 rupees, but I am paying 10 rupees. Then I should not borrow this 100 rupees from the market. I should probably borrow from equity because my business is going concern. I will have to borrow the money, but borrow from equity. Why equity? Then this 10 rupees payment will not be compulsory. Even if you are earning 8 rupees in current year, you can pay 5 rupees to your equity shareholders as dividend. But if you have borrowed from debt, this 100 rupees, you will have to pay 10 rupees and you are earning only 8 rupees on this 100 rupees. What is R? 8% in our case. What is KD? 10%. What does this mean? Company on every 100 rupees is earning 8 rupees but paying 10 rupees. And so this is unfavorable leverage. Try to understand again the meaning of leverage. Leverage is nothing but risk. The next chapter is leverage, so I'm not going into much detail of explaining this. Leverage is nothing but risk. Favorable risk. Then company should take the risk. How to take the risk? Increase debt proportion. Unfavorable leverage. Then company should reduce the risk because the risk is not favorable. Then how to reduce the risk? Decrease the debt proportion. R greater than KD, favorable leverage. R less than KD, unfavorable leverage. R is equal to KD. You are paying also 10%, you are getting also 10%. It does not matter whether you increase or decrease the capital structure. So this is, in our example, 10%. This is also 10%. And this is neutral leverage, or it will not have any effect on our MPS. We have understood one concept of favorable leverage. Try to understand. I am summarizing my concept of trading on equity. This is also one of the favorite question in theory. Trading on equity. It is just 4-line answers. If you increase the debt proportion in your capital structure, of course your risk will increase. But as the debt is less costlier, your value of company should increase if there is a favorable leverage. And when there is a favorable leverage, when R is greater than cost of debt. What is R? What company is earning. What is KD? What company is paying to debt. This is trading on equity. We are taking a decision if we want to borrow 100 rupees from the market, whether we should borrow from equity or debt. In first part of the lecture, Sabina told that there should be mixture of debt and equity. We are now deciding what should be the mixture of debt and equity, and we have made some rules. You should increase the debt proportion in the capital structure if you are having favorable leverage. If you are having unfavorable leverage, you should decrease the debt proportion. And if you are having a neutral leverage, whether you increase the debt proportion, whether you decrease the debt proportion, it will not affect the market price of the share. This is concept of trading on equity. See how I drafted this. Here I wanted that in situation number 1, answer should be highest. So I have taken my EBIT in such a manner that R is greater than KD. So in this situation, it is a favorable leverage. So in favorable leverage, most risky situation will be benefited. Here intentionally I have taken EBIT as 8,000 so that my R comes to 8%. And what is KD? 10%. So R is less than KD, it is unfavorable leverage. This answer will be highest because it is less risky. There will be least amount of debt. Yes, sir, we cannot keep 10,000 debt. Yes, we can keep. That will be a favorable answer. What is the good answer? Least debt in all the situation will be our answer. And in this case, intentionally, I have kept R is equal to KD. I have taken EBIT in such a manner that my R comes to 10%. Cost of debt is 10%. Ultimately, R is equal to KD, and answer of all these three should remain same as per the concept that we have written. So, this again becomes very relevant in understanding the concept of capital structure. See, I have seen students what they do is they mug up the formulas, they do 100 of questions without understanding what they are doing. If you don't know this, just mugging up the question or solving the question is not important. You need to understand what is favorable leverage. Very simple, R greater than KD. If there is a favorable leverage, you should get an answer which is having a more debt, which is having more risk, which is having more leverage. If the R is less than KD, you should get the answer which is having less risk. If R is equal to KD, you should get all same answer in all the situation. This is nothing but understanding of leverage effect, trading on equity. Now this is good. Sir, why the name is a trading on equity? This we understood. If there is a favorable leverage, we should increase the debt proportion. So it is terming it as a leverage effect. Why trading on equity? Try to concentrate. Equity becoming 40,000. Equity becoming 20,000. How equity can become 20,000? From 40,000, you will buy back 20,000 and that buyback money you will raise from that. So you are trading, purchasing your equity, cancelling it and selling that in the market. So it is termed as trading on equity because you are dealing with equity. Ultimately, the equity figure is changing. If you remember, in all three cases, we have changed equity figures only. So we are changing our equity or trading our equity. So it is termed as trading on equity. This is nothing but leverage effect or trading on equity. Last time, I'm just repeating it. If you increase the debt proportion in your capital structure, your value of the company or MPS will increase. This will happen only if you are having a favorable leverage. When will be the favorable leverage? When R is greater than KD. At that time, you are having a favorable leverage. After learning leverage effect trading on equity, let us go to another concept that we need to learn in capital structure, which is financial break-even point. Try to understand what is financial break-even point. You all might have understood in the subject of costing what is break-even point. In costing, this was break-even point. It is level of sales at which you are earning zero operating profit. That is level of sales at which you are earning no profit, no loss. What is financial break-even point? Try to concentrate. It is level of EBIT, and we have learned it, right? What is EBIT? EBIT is nothing but operating profits. Level of EBIT at which your EPS is equal to 0. Earning per share is equal to 0. Level of operating profit at which your EPS is 0. Sir, how it is useful, that I'll tell you. But try to understand first how to find it out. Suppose I am taking one situation. Total capital is a 10 lakh. Equity is a 2 lakh. Equity is 6 lakhs. And debt is 4 lakhs. Cost of debt is the 10%. Tax rate is the 30%. And there is no preference share capital. I want to find out what operating income, if I earn, I will be earning per share 0 rupees. That is, my EPS will neither be positive nor be negative. Then how to find it out? Let us write down our operating statement. EBIT minus interest is equal to EBT minus tax is equal to EAT. In this question, there is no preference dividend, right? So I'm not writing down preference dividend. Divided by number of shares is nothing but EPS. What answer I want? I want EPS as 0. Number of shares can be anything. Say 10,000 in this case. Sir, it may be 2,000, yes. It may be 1,000, yes. But let me take it 10,000. If I want this EPS answer as 0, what is EPS? EAT divided by number of shares. Now, denominator can never be 0. It is 10,000. When the answer of EPS will be 0? When EAT is equal to 0. So, EAT should be 0. If EAT is 0, tax should be 0 and EBT should also be 0. I am going bottom up. If EBT is 0, interest is not 0. What is interest? Interest is nothing but 4 lakh into 10%, which is 40,000. So interest is 40,000. So if you want EBT 0 and your interest is 40,000, then your EBIT should be 40,000. So that your EPS is 0. Financial break-even point when there are no preference shares. What will be the answer? See, 40,000 is the answer, and what is 40,000 is nothing but interest. So, financial break-even point is nothing but interest. If there are no preference shares, let us find out financial break-even point. If there are preference shares, equity of 10 lakh, debt of 10 lakh and preference shares of 5 lakhs. Debt are 10% and preference shares are of 12%. At what level of EBIT? What is financial break-even point? At what level of EBIT? EPS will be equal to 0. Let me again draw that chart. EBIT minus interest, EBT minus tax, EAT minus preference dividend, earnings available to equity shareholders, number of shares, say 10,000 also in this case. EPS, if you want answer of EPS as 0, then your earnings available to equity shareholders should be 0. But preference dividend is not 0. What is preference dividend? 5 lakh into 12%, which is 60,000. So if preference dividend is 60,000, your earning after tax should be 60,000. I hope you all are getting this. I want this answer as 0. If this figure is 60,000, this should be 60,000. Then 60,000 minus 60,000 will be equal to 0. Now comes a somewhat difficult point. Try to concentrate. If earning after tax is 60,000 and tax rate is say 40%. In this case, I am taking 40%. And the tax rate is 40%. Then what should be earning before tax? A simple cross multiplication. Try to concentrate. If your earning before tax is 100, tax will be 40, and so earning after tax will be 60. You can do a simple cross multiplication. 60,000 into 100 divided by 60. 60,000 into 100 divided by 60. You will be getting answer of 1 lakh rupees. So if you want earning after tax of 60,000, your earning before tax should be 1 lakh. Earning before tax should be 1 lakh. So that the tax is 40,000. Interest we know it will be 10 lakh into 10%, which will be 1 lakh. And so your EBIT, if you want EBT of 1 lakh, where interest is 1 lakh, your EBIT should be 0. No, we are going bottom up. If I want this answer as 1 lakh, and if my interest is 1 lakh, EBIT should be 2 lakh rupees. Try to understand what is financial break-even point is not 0. Huh? Financial break-even point is 2 lakh. Level of EBIT rupees 2 lakh, my EPS is 0. So financial break-even point is rupees 2 lakh. In this case, I have got the answer. I have manually calculated it and got the answer. What is once again financial break-even point? The level of EBIT at which EPS is 0. Try to concentrate. Every time I cannot do this. Bottom up. Every time I cannot do this. I'll have to find out a shortcut way whenever there are preferences, how to find out financial break-even point. When there are no preferences, I have done. Financial break-even point is equal to interest. When there are preferences, I want EPS as 0, right? Let me take EBIT as X. Minus interest will be I. What is earning before tax? X minus interest. What will be tax? Suppose tax rate is 30%. It is EBT multiplied by 30%. If the tax rate is 50%, it is EBT multiplied by 50%. What is EBT? X minus I multiplied by T will be your X. What will be earning after tax? It will be X minus I multiplied by 1 minus T. Remember the chapter of cost of capital. You can even solve this. X minus I minus X minus I multiplied by T. X minus I taken as common, answer will be 1 minus T. But we have learned this in cost of capital. If you want to find out after tax cost or even after tax profit, the answer is very simple, just multiplied by 1 minus T. Minus preference dividend I am taking as a P or PD, preference dividend. I will be getting answer of E, earnings available to equity shareholders. What is earnings available to equity shareholders? X minus I, 1 minus T minus preference dividend. All right. And this answer, as we have decided, should be 0. Whatever will be number of shares, but this answer should be 0. When this answer will be 0, let us equalize it with 0. I am solving this. X minus I into 1 minus T minus preference dividend should be equal to 0. So X minus I, 1 minus T, preference dividend going on other side of equation will become plus preference dividend. X minus I is equal to preference dividend. 1 minus T, here it is multiplication. When it will go on other side, it will become division. Minus I want answer of X because X I have assumed it as EBIT. I want level of EBIT at which this is 0 or earning per share is 0. So X is equal to preference dividend 1 minus T. This I will go on other side, will be plus interest. and this will be financial break-even. Let me verify whether my answer is correct or not, because I know one financial break-even point. What is financial break-even point in this case? 2 lakhs. Answer should come 2 lakhs. Let me find out. Preference dividend. What is preference dividend? 60,000. 1 minus 0.40 plus. What is interest? 1 lakh. Answer should be 2 lakhs rupees. Let me do it. 60,000 divided by 0.60 plus 1 lakh is nothing but 2 lakhs. This is nothing but financial break-even point. And let me summarize the first. You don't have to every time do this. You can directly use this and find out financial break-even point. Let me summarize. Financial break-even point. If there are no preference shares, financial break-even point is equal to interest. If there are preference shares, financial break-even point is equal to interest plus preference dividend upon 1 minus T. Sir, you could have directly given us formula and we could have mugged it up and we have got the answer. That is also possible. But understand, knowing something, even if you forget the formula, you can always derive the answer and that answer will be absolutely correct. But now the logically idea should be same. Should be clear. This is level of EBIT at which EPS is 0. Level of EBIT at which EPS is 0. Let us again understand financial break-even point. Company is X Limited. This company can earn EBIT. This is timeline for EBIT of rupees 0 up till rupees infinite. For this company, financial break-even point is rupees 2 lakh. What does this mean? Logically, it should be clear. At EBIT equal to rupees 2 lakhs, at this EBIT, my EPS will be equal to 0. What is financial break-even point? 2 lakhs. See, finance is a decision-making subject. You need to understand what is decision-making. Why we find out financial break-even point? Give me a company who wants to earn 0 EPS. There is no company who wants to earn 0 EPS. Then why we find out financial break-even point? Anyone who can give me the answer. Why we find out financial break-even point if we never want to earn 2 lakhs rupees? Because at 2 lakhs rupees operating income, my EPS is going to become 0. Anyone? Why I need to find out rupees 2 lakhs if I am not if my objective is never to earn rupees 2 lakhs rupees? Yes, if I earn 2 lakhs rupees, my EPS will be 0. Yes, Sabina.
Because we can know that how much fixed component cost we can earn. We can create and to say how much fixed interest I can pay, able to pay, so that I will be not in loss.
Not exactly. Any other student? Yes. Tell me.
Sir, am I audible?
Yes, yes.
Sir, because if any company has not its financial break-even point, then he can assure, or the company's top level management can assure that we have to earn at least 2 lakh rupees for not being a loss-making company.
Exactly. Why financial break-even point is at the tip of the tongue of higher level management? Because they know we need to minimum earn operating income of rupees 2 lakh. They know If their operating income is less than 2 lakhs rupees, their earning per share will be negative. In this case, their EPS will be negative. And in this case, if their EBIT is 3 lakhs, if their EBIT is 5 lakhs, if their EBIT is 10 lakhs, whatever greater than 2 lakhs rupees EBIT, their EPS is going to be positive. See, after calculating everything, at the end of the year, one of the financial accountant comes and says that our EBIT is 9 lakhs, our operating income is 9 lakhs. The management will be rest assured that their EPS is positive. And as simple as this, at this level, EPS is 0. Right? So, Ta is absolutely correct. Company knows that minimum they should be earning an operating income of rupees 2 lakhs to know the see if why you find out financial break-even point in your costing, not financial break-even point in costing. You need to understand how many units or how much sales you should do so that you are earning profits at least, and you are not earning no profit, no loss. This is the concept of financial break-even point. If your EBIT is greater than financial break-even point, you are going to have a positive EPS. If your EBIT is less than financial break-even point, you are going to earn negative EPS. And if your EBIT is exactly equal to financial break-even point, your EPS will be 0. So, how to calculate it is important. Even what it is also important. When you'll go to interview, no one will ask you the formula for financial break-even point. They will ask you the meaning, concept, the use of financial break-even point, and that should be absolutely clear. This was financial break-even point. Let us go to EBIT, EPS, in difference point. Try to concentrate. It is level of EBIT at which EPS is 0. No. Level of EBIT at which EPS is equal. What is it is level of EBIT at which EPS is equal. Try to concentrate. A company is having same company, they are having plan of different capital structure. Plan 1, plan 2. Plan 1, plan 2. Say in this, equity is 40,000, debt is 60,000, total capital is 1 lakh, debt is of 10%. In plan 2, equity is 20,000, debt is 80,000 at 10%. Total should be 1 lakh. You are not in the chapter of capital budgeting, you are in the chapter of capital structure. Total capital should remain same. There are two separate capital structure where you are taking decisions which is better. And in this case, you are not even taking that decision, that which capital structure is better. Preference dividend is not there. Preference is not there. Let us ignore preference right now. I want to find out level of EBIT at which EPS is equal. Level of EBIT at which EPS is equal. Try to concentrate. Equity are of say 100 rupees. level of EBIT. Now EBIT remains same in both the cases, right? It is the same company, same situation, same year, everything same. Just a different capital structure. The proportion of debt and equity is different. Minus interest, I get EBT. Minus taxes, I get EAT. Divided by number of shares, I get EPS. But in this case, I am not having EBIT. I want to find out level of EBIT. So what is question mark? EBIT is question mark. Let me take EBIT as X. So if it is X in scenario number 1, it will be X in scenario number 2. What is interest in plan 1? 6,000. What is interest in plan 2? 8,000. What will be EBT? X minus 6,000. What will be EBT in plan 2? X minus 8,000. What will be tax? Forget right now. I am directly doing earning after tax. I am also teaching you how to do earning after tax. Say tax rate is 40%. What is always the answer? EBT into 1 minus T is nothing but after tax cost or after tax profit. If before tax profit is given and you directly want to find out after tax profit, it is 1 minus T. 1 minus T. And what is T? 40%. So what will be 1 minus T will be 60%. This will be 0.60. Once again understand. If I am earning 100 and 40% is my taxation, 60% will be my after tax income. So directly X minus 6,000, my before tax income, multiplied by 60% is nothing but my after tax income. Same over here. X minus 8,000 divided by 0.60. N in this case will be 400, in this case will be 200. What will be EPS in plan number 1? X minus 6,000 multiplied by 0.60 upon 400 will be EPS. What will be EPS in plan number 2? X minus 8,000 multiplied by 0.60 divided by 200. What I want? I want level of EBIT. Level of EBIT at which EPS is 0. No, at which EPS is equal. At which EPS is equal. So this two should come equal. X minus 6,000 multiplied by 0.60 divided by 400 is equal to X minus 8,000 multiplied by 0.60 upon 200. This is 2 2s are 4. This is X minus 6,000. Can we cut this? 0.30? Yes. This will be X minus 8,000. We can directly cut this. 0.60, 0.60. So this is divided by 2. This is 0.5x minus 3,000 is equal to X minus 8,000. 8,000 goes on this side is 5,000. 0.5x. X is equal to 5,000 divided by 0.5, which will be 10,000 rupees. What is X? Level of EBIT. Let me verify whether my answer is correct or not. If I take EBIT 10,000, this will be 4,000, this will be 2000. This will be 2400. This will be 1200. 2400 divided by 400, so EPS will be 6. 1200 divided by 200, so EPS will be 6. My answer is correct. Level of EBIT at which EPS is equal. If my EBIT is 10,000 rupees, in both the capital structure decision, plan 1, plan 2, scenario 1, scenario 2, my EPS is going to remain same. So whether my debt proportion is more or whether my debt proportion is less, my EPS is going to remain same. Level of EBIT at which EPS is equal. And in this case, the answer is 10,000 rupees. If my EBIT is 10,000 rupees, my EPS will be equal. Sir, how to find out? Every time you will have to do this and find out. Of course, I'll tell you how to shortly make this. But it is every time you will have to equate this equation and find out EBIT, EPS in difference point. Any student who can give me the hint, those who were present in the previous part of the lecture, they can only answer me. Can I find out directly 10,000? And in this question, especially because there is no preference shares, you can easily do it. When I started the question, I was knowing that it is 10,000. No one? Alright. Let me give you the answer. We all know this. When the answer of EPS was equal, see, EPS is 7 over here. EPS is 7 over here. Seven over here, 7 over here, and 7 over here. When the EPS is 7, when R is equal to KD. So, if you want, and here there should be no preference shares. Here there are no preference shares. In our question also there is no preference shares. Right. So, if there are no preference shares, if R is equal to KD, then what should be R? Here KD is 10%. So, R should also be 10%, then my EPS will be equal. What is R? EBIT upon capital employed. What should be R? 0.10. What should be EBIT? That I will find out. What is capital employed? Total capital employed is 1 lakh. What should be EBIT? Rupees 10,000. So that R is equal to KD, so that EPS will be. You cannot do, even if this is more logical, you cannot do this in examination. And of course, you cannot do when the preference share is involved, because preference shares is weird. The rate is fixed, so it is neither equity shares and it is not compulsory if you are not earning profit, and also it is not tax deductible. So it is a weird thing. Whenever preference is involved, you will always have to do it manually. Let us find out. EBIT, EPS in difference point if preference shares are involved. XYZ Limited. Sir, how to find out EBIT, EPS in difference point is this? You will have to do it. There is no other way you can find out EBIT, EPS in difference point. But yes, the working will not be so much lengthy. We will be going in short manner as far as this is concerned. Plan 1, Plan 2. Equity, debt of 10% and preference of 12%. Equity is 1 lakh, debt is 2 lakh, and preference is 3 lakhs. So different capital structure and total capital is 6 lakhs rupees. Then in plan number 2 also, it should be different. It is different. 50,000. Debt is 3 lakh and preference is 2 lakh 50,000. The total capital in both the capital structure should be same. Otherwise, your answer will change. EBIT and total capital always remain same. Rupees 6 lakhs. What question they are asking? They are directly asking what is EBIT, EPS in difference point. Try to concentrate. They are asking us what is EBIT, EPS in difference point. In short, they are asking us what is the level of EBIT at which EPS is equal in both the scenario. Plan 1 and plan 2, I should get EPS equal, not 0, but EPS in both the plans should be equal. Let me find out EPS of plan 1. Yes, I'll tell you. EPS of plan 2. Thank you. Tax rate is say 40%. What will be EPS of plan 1? Now, rather than drawing in a columnar way, let me directly find out the answer. I am always assuming EBIT as X because I want to find out answer of X. So EPS in plan 1 will be X minus interest. What will be interest in plan 1? 2 lakh multiplied by 10%, which is 20,000. This is my earning before tax. What will be my earning after tax? Multiplied by 0.60. What I have done? 1 minus T. Right? What I am doing? EBIT minus interest into 1 minus T. What is into 1 minus T? 0.60. I know what is T? 0.40. And so what is 1 minus T? 0.60. Minus. I will have to reduce preference dividend. What will be preference dividend? 3 lakh multiplied by 12%. 36,000. I have got earnings available to equity shareholders divided by number of shares in plan 1. What will be number of shares in plan 1 if each equity share is of rupees 100? 1000. This is number of shares in plan 1. Let us find out EPS of plan 2 in same manner. X, because my EBIT is going to remain same, minus interest of plan 2 is 30,000 into 1 minus T minus preference dividend. Preference dividend will be 2,50,000 into 12%, which is 30,000. Divided by number of shares. Number of shares is nothing but 500. And at the level of EBIT, that is at X level, my EPS should be equal. So you can just equalize this equation, find out the answer. Is 2. This is 0.6x minus 12,000 minus 36,000 is equal to, this 2 goes over the side, 0.6x minus 18,000 minus 30,000. This is 0.6x minus 48,000 is equal to 2. 0.6x minus 48,000. This will be 0.3x. I am dividing this 2 over here. Minus 24,000 is equal to 0.6x minus 48,000. This will be 0.3x, 0.6x minus 0.3x, 48,000 minus 24,000. X will be 24,000 divided by 0. Rupees 80,000. What does answer means? At rupees 80,000, level 24,000 into 0.3 divided by 0.3, 80,000 is. At rupees 80,000 EBIT, my EPS should be equal. Let me verify. Every time in examination you are not required to verify, but in this case let me verify whether my answer is correct or not. If my EBIT is 80,000 minus interest is 20,000, this will be 60,000, minus tax of 40%. So earning after tax will be 36,000, 1 minus T, minus preference dividend is also 36,000. So this will be 0 and EPS should be 0. In plan 2, if this is 80,000, 30,000, 50,000, 30,000, 30,000 and EPS is 0. In this case it is 0, but 0 is not important. What does EBIT EPS indifference point means? It basically means that your EPS should be equal. In this question, we have taken not an incorrect question, but an inappropriate question whereby EPS is coming 0. Your EPS is not always 0, but EPS will be equal in plan number 1 and plan number 2. Once again, what is EBIT EPS indifference point? It is level of EBIT at which EPS is equal. In both the capital structure plan, in all the capital structure plan, it is level of EBIT at which EPS is equal. This is end of financial break-even point, also EBIT EPS indifference point. Alright, then let us write down all the formulas that we have done today. First, we understood that operating statement starting with EBIT minus interest, I will be getting EBT, minus taxes, I get EAT, minus preference dividend, I get earnings available to equity shareholders. Earnings available to equity shareholders divided by N, I will be getting answer of EPS. And MPS will be equal to EPS multiplied by PE ratio, if PE ratio is available. We have also understood financial break-even point, which is nothing but interest plus preference dividend upon 1 minus T. Now, if preference dividend is not available, it is directly interest. Interest is equal to financial break-even point. We have also understood EBIT, EPS indifference point. Yes, what is financial break-even point? It is level of EBIT at which EPS is 0. So you don't need two plans. In one plan also you can find out financial break-even point. EBIT EPS indifference point is level of EBIT in two plans or more than two plans at which EPS is equal in both plans. How to find out EBIT EPS indifference point? You can assume your EBIT of plan 1 as X minus interest into 1 minus P minus preference dividend upon number of shares in plan 1 should be equal to X minus interest of plan 2 into 1 minus P minus preference dividend of plan 2 divided by number of shares in plan 2. So I have converted it into formula. Find X. You will be getting level of EBIT at which EPS will be equal in both the plans. So I have, instead of writing in columnar form, I have written it in formula form. What is EPS? This is EPS of plan 1. This is EPS of plan 2. EPS of 1 is equal to EPS of 2. I will be finding out X. It is level of EBIT at which both plans are having equal EPS.